Hello and welcome to the Daily Aus. I'm Sam Koslowski.
I'm Billi FitzSimons.
Gold is one of the world's oldest investments. In 2025, it came into the spotlight as a haven for investors concerned about the volatility of our economic markets. Almost 2 months ago, it reached its highest price ever, around $3,800 an ounce. Now that's a pretty big deal when you consider that just 5 years ago, an ounce of gold was worth about half that amount. When gold soars like this, it can impact everything from the jewellery that you might buy to the broader Australian economy. So on today's podcast, we're going to look at what has driven this spike in the price of gold and the mechanics of actually buying the shiny stuff. Just before we get into today's episode, it would mean the world if you subscribed to this channel on YouTube. It really helps us grow and do more independent media here in Australia. Let's get into today's episode.
Sam, before we get into this and why exactly the price of gold has gone up by so much, my understanding of when this kind of thing happens with gold specifically is during uncertain times.
Yeah.
And so I guess my first question is, what is it about right now that I guess is so uncertain, which might sound like a silly question because, I know no such thing. But I know what's going on, I guess, in the world, but how uncertain is today compared to other periods of time?
Well, it's that in that question is a lot of really interesting stuff. I think what's making this moment special for the price of gold is the number of different factors all coming together at once. And if you think about it, there's, the uncertainty around the conflicts in the Middle East. There's the ongoing US-China trade tensions, the rollout of various tariffs by the Trump administration. And all of that together has led to an air of uncertainty. And there's one thing that investors pay particular attention to, not just for gold, but for any stocks, and that's where are the central banks putting their money and where are central banks investing. And some central banks over the last couple of months, including China and Russia, have been buying masses of gold. And that makes sure that they're not too reliant on the US dollar or US government bonds. And when you get these large orders of gold coming through, that can often put the price up.
And when you say central banks,
yeah,
that's countries' main banks?
Exactly. So if you think about the Gringotts vaults of countries, they want more gold in those vaults rather than, say, shares in tech companies or US dollars or euros. They're looking at gold right now because they think that is the safest thing to have amidst all the uncertainty.
And so what makes gold so appealing to investors during uncertain times?
Well, I guess it's all to do with this idea of gold being what investors call a safe haven. And it's the name given to a property that you can buy in times of crisis or uncertainty because it tends to hold its value. Or at least if it does go up and down, it tends to go up and down a little slower and more predictably. So I want you to imagine that you're running an investment company and your job is to take other people's money and make more money from it. And then news breaks of a virus, it might be hypothetically in about March 2020. And all of a sudden, those companies that you're invested in might not be able to run in the way that they did before the virus arrived. You're going to look for stuff to invest in that won't be as affected by border closures or by people getting sick. You can almost apply that same rationale to the last 6 months or so in terms of war or tariffs. And when you're looking for something that's not affected by economic or global chaos, it tends to always come back to gold. That hasn't exactly answered your question in terms of what is it about the gold that makes it so immune. And I'd say that there's a few key factors there. One is that gold doesn't have the same risk that a company has in terms of a company can go under, it can owe you money, it can make your shares be worth zero the next day. Gold doesn't rely on anyone else to pay you back. You've either got gold or you don't have gold.
Because it's a physical thing.
Exactly. You're putting a bet on, essentially, on a company doing well. You are putting a bet on people wanting more gold in the future than they are today. But even if they don't, you still have the gold. And it's globally accepted. This is something that is recognized around the world. It's got this amazing historic context of, think back to ancient civilizations, and gold was the way that you exhibited wealth and you exhibited status. And you can't make more of it. You can't print more gold like you can print more money. You can dig for it, but digging for gold takes a lot of time and resources itself. And then the last reason is that gold just has this enduring quality. that's, I guess, romantically why it's used for wedding bands, is it's durable, it's rare, it's easily split up into a number of different pieces, and you can move it around. And all of that means that you can get a large value of this incredibly valuable stuff into a small amount of space that people are going to want years and decades into the future.
It's interesting because gold on its own doesn't produce anything, obviously.
Yeah.
And so it's not like investing in a company that makes products, for example.
Exactly. I mean, the weird thing about investing in gold is that it just sits there.
But it does get used for things like jewellery.
It does, definitely. And that's where often consumers can feel the impact of rising gold prices. So jewellers will buy their gold from organisations called bullion dealers. They might also buy it from mining companies or other types of wholesalers, but bullion dealers are the main ones. And bullion dealers literally have the gold bars sitting in a safe somewhere.
But so then isn't it, in that sense, it is like a normal company that sells products?
Well, those are companies, yeah. So you can invest in companies that trade in gold, like you can invest in companies that trade in technology. But what we're talking about here is actually investing in the gold. So if you jumped on the Australian stock market, you can buy stocks in gold distribution companies and gold dealers and gold miners. That's different to buying the actual gold itself and buying essentially a loaned amount of gold that somebody else will hold on your behalf. I mean, you can hold your own gold, but that comes with a whole lot of security and logistics risks that most of us don't really want to take.
Okay, so let's say that I do want to invest in gold.
Cool, I've sold you.
How would one actually do that? Either through the ASX or through buying a physical gold bar?
Exactly. So you can buy the physical gold. There are ways to do that, I think.
How do you do that?
I've never bought a gold bar before, but there are trading platforms and retailers, essentially, where you can go into probably the middle of your closest CBD and actually trade in gold. And I mean, if you think about it really tangibly, right now, if you were to buy an ounce of gold, you would pay about $3,300. So you'd go into a shop, pay $3,300, walk out with your gold. If gold went up, you could walk back into that shop in 6 months' time and they would pay you $3,600 for that ounce. So you've made that profit. That's the really tangible way to do it. Now, of course, most of us, if we wanted to trade in gold, we wouldn't have that ability. So you can buy stocks in gold. And that's different, again, to buying stocks of companies that play around with gold. You can actually buy, ETFs, for example, exchange traded funds that are driven by the price of gold. So it's a little bit abstract when you get to the kind of non-tangible part of gold. There are also gold mining companies, as I said. It's all centralized, though, on the value of the price of gold. Because if more people want to pay more for gold, then the mining companies will be worth more as well.
For anyone listening who doesn't necessarily invest, how does something like this, like the price of gold going up by so much, how does this affect them, if at all?
Well, I think the most tangible way would be the price of jewellery. And what happens when gold prices spike like they have recently? Jewellers have to pay more for their raw materials that they then melt down and make into the jewellery that you and I buy. Now, they've got a choice in front of them. They can either pass that cost on to consumers or they can absorb that cost themselves and make less on their margin. But if you were planning to buy an engagement ring or a wedding band, you are looking across the board generally at higher prices than you would have, say, a year ago. But it's not just those big ticket items. It's smaller things like earrings or chains. All of that can become more costly as gold is worth more. And I think that that's probably the most tangible way that people can sense it. But it also has knock-on effects in terms of inflation in an economy. Because if the cost of something like metals goes up, then it tends to have a knock-on effect to everything else that we buy in an economy.
And so it's basically supply and demand. There is a lot more demand at the moment for gold, and therefore the supply is harder and therefore more expensive.
Exactly. And where the safe haven thing comes back in is there's more demand, and it's pretty reasonable to say that demand is not going to fall off a cliff in the next 5, 10, 50, 100 years. It's hard to imagine a world where we don't love gold anymore. And I'm not giving financial advice, and that's very dangerous, but It's a long history, way back to the pharaohs.
Well, I was going to say, many moons ago, I read Barefoot Investor, which is written by Scott Pape.
Yeah.
And I remember he had a section on investing in gold. And he actually wasn't exactly for that. I'm pretty sure it had something to do with dividends and it not providing dividends like other shares do. So do you know that line of thinking, I guess?
Totally. It's one of the key kind of warnings against investing in gold as an investment strategy. And it basically is about this idea of if it's not paying a dividend and if you're only going to get back your money from your investment when you sell gold, hopefully at a higher price, there's no kind of points along the way to take a bit of money off the table, and all that's to do with risk. But the other thing to be careful of, according to financial advisors, is about buzz and hype. And so if you're buying something just because you think that other people are going to want it more than you want it right now, then what comes up may come down. And it can be just as volatile as other investments.
So it's not a perfect solution.
No, and it does trade on fear, right? It trades on this idea that when it seems like the world is falling apart, that gold will go up. And that also means then that when things calm down and get better, gold prices can drop pretty quickly and people put their money back into high-risk tech plays or different countries or different currencies. So there's no silver bullet, or in this case, a gold bullet that can protect you. Thank you.
See what you did there.
That can protect you from everything that's happening in the economy. But hopefully, I think after that, we have a bit of a better sense of what buying gold actually means.
Yeah, I definitely have a better sense now because I've been seeing all of these headlines, but I think that sums it up really well. Thanks, Sam. And if you want more financial explainers from the Daily Aus, we actually have a weekly newsletter dedicated to just that. So we will put a link to that in today's description. Thank you so much for listening to this episode of the Daily Aus. We'll be back this afternoon with your evening headlines. But until then, have a great day.